Hello, and welcome to Cloud9Fin, a podcast on all things leveraged finance. We follow corporate debt from issuance to redemption, credits from performing to distressed, and everything in between. I'm Max Reyes, and today I'm sitting down with Chaney Sheffield and Jonathan Barzideh, who are both co-heads of opportunistic credit at Canyon Partners. They have a broad remit that spans distressed debt, structured credit, and real estate, and we're going to dig into what they do and what opportunities they see in today's uncertain markets. First of all, welcome to Cloud9Fin. Really glad to have you guys here. I want to start with kind of a loaded question. Why is now a great time to be investing in opportunistic credit?
Nice to see you, Max. Should I start it off?
Yeah, kick off.
Okay, so I'm Jonathan Barzideh, here with my partner Chaney. And coming to your question, Max, I would say that the pitch for opportunistic credit has been for a while the lower for longer environment that we were in previously really led to a large amount of unsustainable capital structures in the credit markets. Companies that were over levered, that were banking on zero rates for a while, and that it also created an environment where the credit docs that we're seeing in a lot of these capital structures allow for quite a bit of shenanigans. Fast forward to 2023, 24, where rates started rising really rapidly. These capital structures were really unprepared for the higher rate environment, which really pressured the liquidity for a bunch of these levered companies. And that has been the story for the last couple of years. I think the thing that has changed here in the last couple of weeks and months has been the addition of policy uncertainty that has really thrown the markets for a loop. So, we've looked at a lot of situations where companies and owners have tried to buy a lifeline to bridge through this higher rate environment through somewhat depressed EBITDA to get to a future where they could see a rebound in earnings and a refinanceable capital structure. And the theme for a long time with a lot of the LMEs that people have been working on is stay alive for 25, and then you get to 25, and now we've got tariffs and rate issues.
I think, Max, JB and I have been at Canyon for 17, 18 years, and we've always shown when there's uncertainty, right? With uncertainty, it's opportunity. It's generally not that great for the equity side of the capital structure, but it gives us opportunity to deploy money in credit at much more.
And that's the name of the game, literally, right?
Name of the game since 22, and inflation and interest rate liftoff. It's been a totally different ballgame.
Yeah. And so I want to pause for a minute just for our listeners. When it comes to opportunistic credit, I think everyone has a slightly different definition of it, depending on where you go, right? Canyon's version of opportunistic credit isn't going to be the same as, say, when Marathon talks about it. So I'm wondering if you guys could just kind of, in your words, define what specifically you're looking at and what kind of your priorities and mandates are when it comes to investing, and what makes Canyon's opportunistic platform unique in that regard versus other strategies out there.
Well, you chime in, but I think Canyon's capital has always been defined by flexibility. And so we go where there's opportunity, and whether that's a healthy credit that needs some sort of structured infusion, or whether it's just old school distressed, we kind of span the whole spectrum and are looking to, generate those mid to high teens returns.
Yeah, gotcha.
And our platform is really kind of go anywhere in the sense that we're looking at corporates, we're looking at real estate, and we're looking at the structured products market as well. We're seeing opportunities in a bunch of them. And it really gives us the ability to kind of line up the risk reward function for a variety of different bets that we can make in the portfolio.
We were talking just a second ago about policy uncertainty and the avenues and opportunities that creates. Just to give our just to give our listeners a sense of the timing of this, right? We're talking April 30th. Obviously, April 2nd was when the president here in the U.S. laid out his tariff policies and kind of the agenda there. We've seen a lot of uncertainty and a lot of kind of things switching almost, it feels like, day by day. What is that? How are you guys able to capitalize on that? What does that mean for the market, and what specific opportunities as specific as you can talk about them, right, has that created that didn't exist before Americans were not worried about tariffs because it just was not on the policy agenda?
It feels like liberation, doesn't it?
That's why they called it Liberation Day.
Well, I mean, super big picture, you can see the sell side has just increased the probability of recession globally and here in the U.S. And that is just repricing risk across the board. The volatility, obviously, in the headlines and the tweets, has led to significant gyrations in the market. Much more pronounced in the equity market, I would say, than the credit markets. The credit markets always take a little bit extra time to digest what the real policy is going to be, which is still highly uncertain. But we have all our analysts re-underwriting each of our credits, looking at new opportunities, who's most directly impacted by the tariffs. I'd say the overarching theme so far is how big is the indirect impact of tariffs going to be on the consumer, on
Supply chains,
yeah. And what are the next derivative impacts of the tariffs. Like I said, the last 30 days it felt like 300 days, but
yeah, and I would also say that to Chaney's point, there's definitely a lot more volatility that we're seeing in the equity markets, but the credit markets have started to gyrate, and on top of that, we're seeing in a lot of situations liquidity dry up, which will be the precursor to exacerbating the moves when somebody gets tapped on the shoulder and is told that they need to get out of a position. You can see some significant moves, for that liquidity.
That makes sense. And obviously, right, if you're importing a lot, if your business is sourcing from one of these countries impacted most heavily by tariffs, specifically China at this point, you're in trouble, right? But is this situation also crowning winners from what you guys have seen in terms of companies that have either onshore supply chains or otherwise are not kind of in the path of these tariffs?
I would say that's on a relative basis. So the winners are going to be those least exposed. In some cases, would face competition from foreign imports that might feel a little bit of a benefit from not getting those products dumped into the markets at low prices. But in general, I think the pervasive view is that it is a global tax. It is a fiscal restraint that will just lead to just generally slower economic activity. And obviously, the M&A market and the broadly syndicated loan market and the high yield market has really seized up over the last 30 days. Will that come back? I mean, I'm sure it will calm down, but that is all tied to getting a little bit more certainty as to what the policy will ultimately be.
Yeah, and I think the issue is that, like, even if you think a company has the potential to be a winner because they make more of their stuff in the United States, for example, the problem is that their supply chain isn't all U.S. And so they are seeing issues too. If you think about kind of like the auto sector, for example, right? Especially on the EV side, access to rare earths is going to be an issue for a lot of companies too. And so I think right now, the name of the game is there are still unexpected problems that, like, known unknowns that the market is still waiting for. And we haven't seen the full impact of that yet. The emergence of real winners probably comes in the second stage.
Gotcha. No, that makes sense to me. And let's talk a bit more about structured credit. You mentioned there being, it sounds like Canyon strategy is very inclusive, right? When you guys see opportunity, you can go for it. But I'm curious as to like the specific areas there that are of interest and sort of how you guys think about that space and not why you play in it so much as what you have to do in there, right? Like what opportunities exist and what the appeal is.
Sure. And by way of background, the structured product space is an area that has been, a core part of Canyon's strategy, coming out of the GFC even for a very long time. We've found things that we find interesting in that market. And in 08, 09, 10, there was a lot of, dented, busted, alt-tape, subprime mortgages that we were focused on. And here, the focus has been much more associated with the consumer and the resi market. thus far. The interesting thing to note is that in terms of the residential market, U.S. homeowners are sitting on as much home equity as they've had in the last 20, 30 years.
Yeah.
There's a lot of home equity out there, and those borrowers or potential borrowers are looking at the equity in their home as a release valve in terms of the pressures that we're seeing on the economy and inflation. And if you are a prime borrower, if what we're focused on is the higher quality borrowers. And if you're a prime borrower, 740 FICO score, you probably in the last few years had the opportunity to refinance your mortgage at a 3 handle or better, and you have a really attractive piece of capital in your capital structure there that you really don't want to touch. But if you do want to do a home renovation or pay for your kids' college or something like that, and you want to tap the equity in your home, you're not touching your first mortgage, but as an example, you would be touching the second lien potential in your house. And so we're seeing opportunities, as an example, in the second lien space, where you can find borrowers that through the second lien are borrowing up to 65% LTV in their homes, 740 type FICO scores, really solid credits. And those structures to us look pretty attractive. And we've been developing relationships with a variety of originators in the space, companies that, from coming out of the regional banking crisis we had a couple of years ago, and even now the volatility that we're seeing, have recognized that there's value in having alternative sources of capital beyond the direct securitization market. And we can be a bridge to those markets as well, where we step in the interim and then help with the securitization down the road. And so we're seeing very attractive IRRs in those types of investments.
As this economic uncertainty mounts, right? Just given people don't know what they're doing, I would happen to the home equity you're talking about is even more appealing than it was before versus being a rainy day fund. Now, you can kind of reach for it as not a security blanket, but right? Is that some of the thinking there?
I would agree with that. And I think that if we think about kind of the long-term prospects for the economy, like that can be a little bit of a release valve on the pressure, at least as with regards to, a portion of the consumer base, right? Not everybody owns a home, but for a portion of the consumer base, that will be a release valve. And in as much as we believe here at Canyon, I think a lot of people are saying that this is one of the more compelling opportunistic credit environments that we've seen in a very long time, maybe rivaling the setup to the GFC. The difference between where we are today and the setup in the GFC is that what got us into trouble in the GFC was the over levered consumer and what was happening in the housing market, and that's not the situation here. So very different backdrop, even if the opportunity set looks equally compelling.
Yeah, critically, we're running all our scenarios through kind of GFC levels of defaults and pain, and we don't think that's likely given the consumer is in a much healthier spot. And the other nice thing about securitized products is no LMEs.
Well, let's talk about LMEs. You guys mentioned shenanigans a little earlier in terms of loose credit documents. I did not forget the use of that term. For listeners who, for whatever reason, are listening to a 9fin opportunistic credit podcast and don't know what an LME is, that's a liability management exercise. It's essentially when a company cuts a deal to give it some runway, right? Give it some breathing room in terms of liquidity, in terms of maturities, but ends up leaving certain creditors out of that deal, essentially, right? To boil it down to its most basic. We've seen them change quite a bit over the last few years. When you guys are thinking about opportunities, how worried are you of the threat of an LME, the threat of a deal away, right? When a company does business with, someone who's new to the cap structure, and conversely, everyone to some extent partakes in these kinds of transactions, right? How are you guys thinking about the game theory about whether or not to pull the trigger on a transaction when a company comes to you and goes, hey, we have an idea for something a little creative. Some other people might get burned. What do you think?
Well, we're credit people, so we're always worried.
Yeah, that's fair.
That is definitely like number 1, 2, and 3. Make sure you can read the room, see which ways this situation might address their liquidity needs or extension of runway, or just opportunistically trying to exact discount out of creditors. The number one way we've tried to protect against that is choose credits that you like.
Yeah.
Because, the best defense is a good offense in this case, and you have to be willing to be at the table providing solutions for the company, kind of butt your way into the process, and it very much relies on deep relationships, both across our competitors and fellow creditors, but the advisors, the companies, the management teams. And I think that plays directly into our strength, because we have been for the last 30 plus years set up as industry coverage, and all our analysts, we pride ourselves on having long-term relationships, long-term coverage of these situations. But the number one thing is make sure you like the asset and come ready to work constructively, I think.
I think that's a really important point, because just to expand on that for a second, we find that the nastiest LMEs that occur, LMEs have a variety of flavors, as you know, Max, and the nastiest LMEs are in situations where the fundamentals of the company are still deteriorating, and people really have their knives out trying to figure out how they can maybe rob from each other to better their outcome, because they don't see any other prospects for an improved outcome. And then there are LMEs in situations where the operations of the company are such that they're on the uptick, and things are improving fundamentally. And then the attitudes of the people around the table shift pretty dramatically in those situations. And you can have the friendlier LMEs where people are happy to be more constructive and bridge towards a refinancing down the road that they can believe in.
And sometimes that means sitting it out and waiting for the LME, right? You sit it out, see the new cap structure, because you're often exchanging that flexibility that the sponsor has for discount. And once the extension has been granted, then now it's back to older school restructuring, where you're trying to pick the fulcrum or pick a attachment point that works for your risk reward profile.
Yeah, and once an LME is done, the docs are going to be way tighter, right? And that's kind of, you don't have to worry about it as much.
For sure.
Unless you find 51% of your friends.
Well, I only try to do deals with 59% of my friends.